The bullion banks have officially declared war. For the last 72 hours, we have watched a battle play out on the charts that is unlike anything we have seen in the history of the modern metals market. It is violent, it is desperate, and it is occurring at a very specific, very critical line in the sand. That line is $92. If you look at the price action from Thursday, January 15, 2026, you do not see a market finding its equilibrium. You see a crime scene. You see a series of coordinated high-frequency attacks designed to defend a solvency level that the banks simply cannot afford to lose. Let's reconstruct the timeline of the battle. In the early morning hours, the price of silver surged. It hit an all-time high of $92.23. The momentum was vertical. The buyers were aggressive. It looked like we were going to break through the century mark in a single session. And then the hammer came down. In a matter of minutes, a massive wave of paper selling hit the Globex market. It wasn't physical selling, it was algorithmic shorting. It smashed the price from $92 all the way down to $86.20. That is a $6 drop in the blink of an eye. The mainstream media immediately published their headlines. They called it a crash. They called it a bubble bursting. They told you that the rally was over and that smart money was exiting. But then something happened that wasn't in their script. The market fought back. The buyers stepped in at $86. They bought the dip with a ferocity that stunned the short sellers. Within hours, the price ripped back up. It crossed $88. It crossed $90. It climbed all the way back to $91.50. The market refused to die. So the banks reloaded. They executed a double tap just as the price was approaching that critical $92 level again. Another wave of selling hit. They smashed it back down to $87.80. They tried to break the psychology of the bulls. They tried to induce panic. But look at where we are sitting right now. As I speak to you, the price of silver has bounced again. It is trading back around 90-30, up, down, up, down, up. This volatility is not natural. This is the visual representation of a war of attrition. On one side, you have the physical reality. You have the industrial buyers, the sovereign wealth funds, and the retail public who know that silver is running out. They are buying every dip. They're creating a floor made of concrete. On the other side, you have the paper establishment. You have the commercial banks who are holding billions of dollars in call options that expire this week. Why are they fighting so hard for $92? Why not $95? Why not $85? Because $92 is likely the strike price for a massive wall of derivative bets. If the price of silver settles above $92 at options expiry, the losses for the banks go from manageable to catastrophic. They move from the trading desk to the boardroom. They become Salvini issues. So they are burning their own furniture to keep the house warm. They are selling contracts they do not have. They are exhausting their ammunition to defend a line on a chart. But the resilience of the market at $90 tells us that they are failing. In previous years, a smash to $86 would have triggered a cascade of selling. It would have sent the price down to $70. It would have taken weeks to recover. Today, it took hours. This V-shaped recovery is the ultimate signal of underlying strength. It proves that there is a bid underneath the market that is deeper and stronger than the bank's ability to suppress it. When you smash a ball underwater, it pops back up. The harder you push it down, the faster it rises. The banks are pushing down with everything they have, but the buoyancy of the physical market is overpowering them. This ping-pong volatility is designed to make you dizzy. It is designed to make you nauseous. They want you to look at your account balance swinging by 10% in a day and say, "I can't handle this." They want you to hit the sell button just to get some sleep. Do not give them that satisfaction. The volatility is the noise. The bounce is the signal. The fact that we are sitting at $90 after two massive attacks is a miracle of market strength. It confirms that the $80 level is ancient history. It confirms that the $70 level is a memory. We are building a new base at $90, and we are doing it in the face of the most aggressive suppression campaign since 2011. But here is the most important question. Why did the price bounce? Who stepped in to buy when the chart looked like a waterfall? It wasn't the retail investor. The retail investor was paralyzed by fear. The entity that bought the dip at $86 and $87 knows something that the paper traders do not. They know that while the price in New York was crashing, the price in Shanghai didn't flinch. In the next part of this deep dive, we are going to look at the Shanghai lie detector. While the COMEX was painting red candles, the Shanghai Gold Exchange was trading at $99.69. We are going to analyze the $13 premium that just opened up between the East and the West. This spread is the reason the banks cannot win. It is the reason the price keeps bouncing back. The banks are fighting a local war in New York, but they are losing the global war to China. The war for 92 is just the opening skirmish. The real battle is about to begin. If part 1 was about the battle on the screen, part 2 is about the reality on the ground. While the algorithms in New York were busy painting the tape red, while the high-frequency traders were smashing the price to $86 to save their options bets, the Shanghai Gold Exchange sent a message that should terrify every central banker in the Western world. They didn't sell, they didn't panic, they simply widened the spread. We have analyzed the closing data from the Asian session, and it reveals a tale of two markets. While the Globex market was crashing, the Shanghai market was trading at $99.69. Let's call it what it is, $100. When you compare the intraday low in New York of $86.20 to the closing price in Shanghai of $99.69, you get a differential of $1,349. We are looking at a premium of over $13. In the world of logistics and arbitrage, a $13 gap is not a spread. It is a financial suicide note for the comics. It is the Shanghai lie detector proving that the price drop in the United States is mathematically illegitimate. Let me explain why this spread makes the bank's war for $92 a feel exercise. Commodities are global assets. An ounce of silver in New York is the exact same chemical element as an ounce of silver in Shanghai. It conducts electricity the same way. It reflects light the same way. It holds value the same way. In a functioning market, the price should be roughly the same everywhere, minus the cost of shipping and insurance. When the price in New York drops $13 below the price in China, it creates a vacuum. It creates a gravitational pull that is stronger than any central bank policy. Think about the physics of this trade. If you are a global trading house, a Glencore, a Trafigura, or even a Chinese state-owned bank, you're looking at a risk-free money printing machine. Traders can buy a paper contract on the COMEX for $87. They can stand for delivery and take the physical bar. They can put that bar on a plane to Shanghai, and you can sell it immediately for $100. They make a $13 profit per ounce. That is a 15% return on capital in a matter of days with zero market risk. This trade is happening right now. As we speak, pallets of silver are being moved from vaults in London and New York to be shipped east. The arbitrage vacuum is sucking the Western vaults dry by smashing the paper price to $86. The Western banks have effectively put the entire United States silver inventory on a flash sale for the Chinese industrial complex. Think about the geopolitical irony of this situation. The United States government is holding G7 meetings about securing critical minerals. They are terrified of running out of silver for missiles and solar panels. And yet, the banks that operate within the U.S. system are actively subsidizing the export of that strategic mineral to our biggest geopolitical rival. Every time they smash the price to defend their short positions, they are making it cheaper for China to corner the market. They are burning the nation's furniture to keep their trading desks warm for one more night. This is why the price bounced back to $90 so quickly. The market realizes that the 86's price is unsustainable. If silver stays at $86 in New York while Shanghai pays $100, the COMEX will be empty by the end of the month. The exchange cannot survive that level of drain. To stop the drain, the price in New York must rise to meet the price in Shanghai. It acts like a rubber band. The further the banks stretch it to the downside in New York, the harder it will snap back to the upside to meet reality. The Shanghai lie detector tells us that the true value of silver is not $90, it is $100. The chart in New York is simply a lagging indicator. It is a distorted signal that is being manipulated by entities that are on the wrong side of the trade. But there is another layer to this $13 premium. It tells us about the nature of the demand in China. Why is China paying $100? Why aren't they waiting for the dip like the Americans? Because their demand is inelastic. China dominates the global solar panel industry. They produce over 80% of the world's photovoltaic modules. They dominate the electric vehicle battery supply chain. These industries consume massive amounts of silver. A solar manufacturer in Shenzhen cannot stop production just because the price of silver goes up. If they stop, they lose market share, they have to buy, and they are willing to pay a premium to ensure they have the metal. The $13 premium is the cost of security. It is the price Chinese industry is paying to ensure they do not run out. They are hoarding. They are moving from just-in-time inventory to just-in-case inventory. They are building a strategic stockpile because they see what is happening to the dollar. They see the debt, they see the inflation, and they are voting with their wallets. They are dumping paper assets and accumulating hard assets. This creates a floor under the market that is made of concrete. You cannot shake out a buyer who needs the metal to keep their factory open. They will not sell if the price drops. They will just buy more. This is fundamentally different from a speculative bubble. In a bubble, people buy because they think they can sell it to a greater fool next week. In a shortage, people buy because they intend to use it. So, when you see the volatility in New York, the drop to 87, the rip to $91, do not get dizzy. Anchor yourself to the Shanghai price. As long as Shanghai is trading near $100, any price below $95 in the US is a gift. It is a discount window that has been left open by the incompetence and desperation of the short sellers. But this window will not stay open forever. Arbitrage gaps always close, and they usually close violently. We are setting up for a snapback event where the US price gaps up overnight to close the spread. We could see a day where silver opens at $95 and closes at $100 simply to stop the physical bleeding. The war for 92 is really a war against reality. The banks are fighting to keep the illusion alive that silver is worth less than it is. But reality has a way of winning eventually. Physics always wins over paper. The $13 premium is the proof that the paper market is broken. It is the proof that the price discovery mechanism has moved from the west to the east. New York is no longer the captain of the ship. We are just the passengers, and the ship is sailing to Shanghai. In the next part of this deep dive, we're going to look at the paper war. We're going to analyze the specific mechanics of the naked short positions that are driving this volatility. We're going to explain why the banks are trapped, why they cannot cover their positions without sending the price to the moon, and why they are forced to double down on their attacks even though they know it is a losing strategy. It is the psychology of a gambler chasing his losses. They are all in on the short side, and the market is moving against them. The Shanghai price is the margin call, and the phone is ringing. We have analyzed the crime scene on the charts. We have analyzed the $13 lie detector in Shanghai. Now, we must take a look under the hood of the machine itself. We need to understand how the banks are manipulating the price, and more importantly, why their manipulation is turning into a suicide mission. When you see the price of silver drop from $92 to $86 in 10 minutes, your instinct is to ask who is selling. You imagine a line of investors holding physical bars of silver, deciding all at once that they hate the metal and want cash. You imagine trucks pulling up to the warehouse to dump supply. But that is not what happened today. There was no physical selling. Samsung did not sell their battery stockpile. The US Mint did not sell their inventory. They don't even have any. The Chinese did not sell their solar reserves. The selling was entirely digital. It was paper. This is the mechanism of the naked short. To smash the price, a bullion bank does not need metal. They only need collateral. They enter the futures market, and they sell a contract that promises to deliver silver in the future. But they don't have the silver. They have no intention of getting the silver. They are selling a promise. When they sell 10,000 contracts in a single minute, the algorithm on the other side sees a massive spike in supply. It assumes that there is a glut of metal hitting the market, so it marks the price down. It is a magic trick. They create virtual supply out of thin air to overwhelm the real demand. For 40 years, this trick worked perfectly. The banks would print paper contracts, the price would crash, the hedge funds would panic, and the banks would buy back the contracts at a profit. It was the perfect crime. But today, the crime failed. Why? Because of the beach ball effect. Imagine you were in a swimming pool. You are holding an inflated beach ball. That ball represents the price of silver. The water represents the physical reality, the industrial demand, the inflation, the Shanghai price. The banks are trying to hold the ball underwater. They want the price at $86, but the physical reality wants the price at $100. To keep the ball at $86, the banks have to exert constant, massive downward pressure. They have to use all their energy. They have to sell more and more contracts just to keep it submerged. But the deeper they push it, the greater the pressure becomes. The buoyancy of the market increases. When they smashed the price to 86.20 this morning, they pushed the beach ball deep underwater. But the moment they lifted their hand, the moment the selling stopped, the ball rocketed back to the surface. It ripped back to $91. This is the physics of a broken market. The natural state of silver is now much higher than the paper price. The banks are fighting gravity. And this brings us to the double tap. And why did they smash it again? Why did we see a second wave of selling that drove the price to 87.80? Because the beach ball popped up too fast. It threatened to breach the $92 surface again. And if it breaches $92, the banks drown. The second attack was an act of desperation. It shows that they are terrified of the resilience. In a bear market, you smash the price once and it stays down. In a bull market, you smash the price and it acts like a trampoline. We are witnessing a paper war where the banks are firing ammunition they cannot replace. Look at the open interest data. Usually when the price crashes, open interest should drop. That means longs are liquidating. They are giving up. But today on the drop, open interest actually rose. This is a critical forensic detail. It means that for every contract the bank sold to smash the price, someone else stood there and bought it. The market absorbed the paper. The banks threw their best punch and the market didn't blink. It just opened its mouth and swallowed the liquidity. This suggests that the paper short is being met by a physical long. The entities buying these contracts at $86 are likely the same entities draining the vaults. They are using the futures market to secure delivery. They are taking the other side of the bank's bet, and this creates a suicide mission for the banks. Every contract they sell at $86 creates a liability. They are now legally obligated to deliver silver at $86. But where are they going to get it? They can't get it from Shanghai. It costs $100 there. They can't get it from the dealers. The street price is $120. They can't get it from the mines. The supply is hijacked. They have sold something they cannot acquire at a price that guarantees a loss. They are digging a hole so deep that they will never climb out of it. They are investing that they can scare you into selling your physical silver back to them. That is their only exit strategy. They need you to fold. That is why the volatility is so extreme. They need to break your psychology because they cannot break the math. If you hold your position, if the industrial buyers hold their position, the banks are mathematically insolvent. They are shorting a market that has run out of inventory. This is why I call this the war for 92. It isn't just about a price level. It is about the survival of the suppression machine. If $92 falls and the bounce to $90 suggests it will fall very soon, the banks lose control of the narrative. The call wall at 92 triggers. The option dealers have to buy futures to hedge. The short covering begins. It triggers a gamma squeeze. We are seeing the setup for a vertical move that makes today's volatility look like a warm-up. But there is a trap here for the leverage trader. The banks are cornered animals, and cornered animals are dangerous. They will try again. They might try to smash it to $85 overnight during the low liquidity Asian Open. They might try to engineer a new scare. They will do anything to avoid the inevitable. But remember the beach ball. Every time they push it down, they are just adding energy to the eventual explosion. The $13 premium in Shanghai is the force that guarantees the ball will rise. The paper war is a distraction. It is a light show designed to blind you to the reality of the physical drain. While the ticker flashes red and green, the vaults are emptying. The trucks are moving. The ships are sailing. The banks are trading digits. The world is trading atoms. In the final part of this deep dive, we are going to look at the strategy. We are going to discuss how you should navigate this war zone. We are going to give you the verdict on the $92 level. Will it hold, or will we see a breakout to triple digits by the end of the week? And most importantly, we are going to remind you why you own silver in the first place. You don't own it to trade against a rigged algorithm. You own it because the algorithm is breaking. The banks have declared war on the price, but they forgot one thing. You can't print silver. The battle is raging, the lines are drawn, and the paper tigers are running out of paper. We have arrived at the conclusion. If you have been with me through this battlefield assessment, you now understand the full scope of the war we are fighting. You understand the double tap smash where the banks tried to break the $92 level. You understand the Shanghai lie detector which proves that the real price of silver is already over $100. And you understand the paper war mechanics, the naked shorting, and the beach ball physics that are driving this unprecedented volatility. The evidence is overwhelming. It is forensic. It is undeniable. Today, Thursday, January 15th, 2026, will be remembered as the day the bullion banks threw everything they had at the market and lost. We are looking at the chart right now. Silver is trading at 90.30. Think about what that number represents. It represents a market that was hit with millions of ounces of paper selling, a market that was dragged down to $86, and a market that simply shrugged it off and climbed back up. This is the verdict. The verdict is that the $80 level is the new floor. The verdict is that the banks are powerless to stop the ascent. And the verdict is that $92 is not a ceiling. It is a speed bump on the road to triple digits. So where do we go from here? What is the strategy for the individual investor standing in the middle of this crossfire? First, we must define the endgame. The banks are fighting for $92 because of options expiry. That expiry happens this week. Once that date passes, the incentive to suppress the price evaporates. The boot comes off the neck of the market. This means that next week, we are likely to see the snapback. The energy that was stored during the suppression phase will be released. The rubber band will snap. And because the Shanghai premium is $13, the target for that snapback is obvious. It is $13. That is the price required to close the arbitrage gap. That is the price required to stop the physical drain. We are looking at a potential $10 gap up overnight. But you have to survive the next 24 hours to get there. The banks are cornered animals. They will not go quietly. They might try one final Sunday night massacre. They might try to induce a flash crash during the Asian Open when liquidity is thin. Your strategy must be radical inactivity. Do not trade this market. Do not try to time the swings. Do not try to sell at $92 and buy back at $88. That is how you lose your position. That is how you get left behind when the vertical move happens. If you hold physical silver, you have already won. You have exited the casino. You're holding the chips while the house burns down. Let's talk about the real price. We established in part 2 that dealers are charging $120 for physical metal. That is the street price. If the paper price is $90 and the street price is $120, you are holding an asset that is effectively trading at a 30% discount on the screen. Why would you sell a discounted asset? You wouldn't. You would buy more. This is the liquidity trap for the banks. They need you to sell so they can cover. But because the street price is so much higher, nobody wants to sell the paper contract. They want to take delivery. This forces the banks to bid the price up against themselves. We are entering a phase called the churn. This is where the price grinds higher day after day. Regardless of the news, regardless of the dollar, regardless of the technical indicators, it grinds higher because the vaults are empty. We saw the data. 1.3 million ounces left JP Morgan yesterday. That metal is gone. It is not coming back at $90. It might come back at $200, but not today. So the verdict on the war for 92 is clear. The line is held. The buyers have defended the fortress. The sellers are out of ammunition. But there's a bigger picture here, a picture that goes beyond the chart. We are witnessing the transfer of pricing power from west to east. For 50 years, New York set the price. Today, Shanghai sets the price. This is a geopolitical earthquake. It means the United States dollar is losing its privilege. It means that the ability of Western banks to print paper gold and paper silver to control inflation expectations is broken. When you hold silver, you're betting against that control. You're betting on reality. The volatility we saw today, the crash to 86, the rip to 91, is the death rattle of the old system. It is the sound of the gears grinding as the machine fails. Do not be afraid of the noise. Embrace it. Volatility is the price of admission for the greatest wealth transfer in history. So what should you do tonight?